Good morning and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald. Thanks as always for joining me. I hope that you're off to a great start today and having a wonderful afternoon wherever this video finds you. Sorry, I'm a skosh later than usual, and thanks for your understanding. I am a little bit later than usual because I did quite a bit of shopping yesterday and I want to make sure all those orders are filled. Why? Because I wanted to take advantage of the downdraft that Uncle Jay Powell, as in Chairman Powell of the U.S. Federal Reserve, created when he began flapping his jaw. More in a moment on that one. And I hope you did the same. Always remember that the markets are the only store on earth where people fear a sale. So get busy whenever you got one. Here's my playbook. Rallies don't tend to die of old age. They die because the Fed kills them. Now, the markets were moving along just fine yesterday until Fed Chair Jerome, it's transitory Powell, got his mitts on a microphone. Figures, doesn't it? Anyway, suddenly he's an expert about the stock market and he's concerned. I mean, really? Makes my brain explode. But here's the deal. Powell is clearly not stupid. So what gives? Why does the market react like that? It's simple. Number one, the Fed's models are based on an economy that no longer exists, and they use metrics that no longer matter and data that is increasingly Stone Age. Number two, the Fed collects data using horse and buggy methods at a time when the world is increasingly operating in real time at Silicon Valley speed. Powell may as well be driving down the road while he's looking only in the rearview mirror. But we can't do anything about that. Anyway, Keith's investing tip is related in this department. The world's best companies are not dependent on the Fed, let alone on what Jay Powell thinks. If anything, they are charged with producing profits despite what he thinks and despite it all. And the markets reflect that. So, point being, find great stocks. Your portfolio will thank you. Number two, this is a big one. How much cash should you keep on the sidelines? Well, I joined my good friend and colleague, the super smart Scott Shelley, aka the Cow Guy, on RFD TV yesterday for a timely conversation about exactly that. You can watch this video elsewhere on my channel. But the question, of course, is how much do you keep in cash versus how much do you put in the markets? Right now, my POV is that trading short-term thinking for long-term solvency is never a good bet. Here's why. Any pain investors think they're avoiding today by steering clear of what they perceive to be dicey markets will pale in comparison to the pain of running out of the money in the future. Just saying. Number three, Micron, buy, sell, or hold. Well, this is interesting because Micron just reported earnings that beat expectations across the board. I loved what I saw. EPS came in at 303 versus 286 expected. Revenue hit 11.32 billion versus 11.22 expected. Guidance for next quarter was 12.5 billion versus 11.94. Consensus, overall sales rose 46% year over year. I mean, that's a big number. Cloud unit revenue tripled to 4.54 billion with a B, and data center revenue fell 22% to 1.57. Now, Micron has nearly doubled in 2025 as demand for high bandwidth memory (HBM) chips surges alongside NVIDIA and the AI boom. Now, CEO Sanjay Mehrotra, I'm sorry, I can't pronounce that correctly, put it bluntly, as the only U.S.-based memory manufacturer, Micron is uniquely positioned to capitalize. And I don't disagree. In fact, this is not surprising to me at all. In fact, this repetitiously redundant this morning, as my ninth grade English teacher would say. In fact, I'd have been shocked if they didn't beat what's happening, given what's happening in AI. So, should you buy Micron? Before you do, consider this. My research suggests that there are 10 to 15 stocks out there with Palantir-like potential, and Micron isn't one of them, in my humble opinion. Since Palantir bottomed out at 609 on January 6, 2023, and I encourage investors to get on board, it has returned 2,773 and some odd percent. The S&P 500 has turned into very healthy, but still far less, 81%. Over the past 12 months, the numbers are similar. Palantir has returned 377%, while Micron and the S&P have returned 75% and 17.79%, respectively. Micron's a great company with a lot of great potential, and if you're going to invest, you want to constantly make a series of trade-offs. Do you think Micron has Palantir-like potential? If not, buy Palantir. If you think it does, then buy Micron. Either way, what I want you to think about is you buy the best, ignore the rest, however you define it. And, of course, you know what to do. Number four, get on board with AI or get left behind. OpenAI, Oracle, and SoftBank have just announced plans for 5, count them up, 5 new AI data centers as part of the $500 billion Stargate project. Now, new sites are going to be built in Texas, New Mexico, Ohio, and the Midwest. Total data center capacity is now projected to hit nearly 7 gigawatts within the next 3 years, up from 400 billion already in the pipeline. Now, the project is expected to create 25,000 on-site jobs at those locations. NVIDIA will invest up to $100 billion in OpenAI and supply the chips powering these builds. I mean, it doesn't get any better than this. Now, to be fair, CEO Sam Altman summed it up neatly. AI can only fulfill its promise if we build the computational power to power it. So, no surprise, at least to me, again, and hopefully not to you either if you've been reading along for any length of time whatsoever. AI isn't just a technology, it is the technology, perhaps of all time. Projects like Stargate are about building digital infrastructure that will alter the course of humanity for the next 50 years or more. Yet they are already having a profound impact on investing today, which is why we talk about it so much. Now, if you're already on board with your favorite AI infrastructure names, fabulous. If not, what's happening in Texas is another reminder that the window to get on the path to profits is closing fast. So do something about it. And finally, number 5, Lithium America's shares have soared 80% as I record this. This is another big one. Lithium America's shares soared nearly 80% after reports that the Trump administration wants an equity stake in the company, meaning they want to own part of it. Now that makes sense to me. Lithium is a critical material for EV batteries, and the supply chain independence is a national security issue. Lithium Americas owns 62% of the Thacker Pass mine in Nevada. GM, believe it or not, owns 38%. Thacker Pass is expected to become one of the largest lithium sources in North America when operations begin in 2027. And the White House is linking the stake to a renegotiated $2.2 billion Department of Energy loan. Now, this would be the first U.S. equity stake in a Canadian miner. LAC is actually based in Vancouver, but it trades in Toronto and on the New York exchanges. The DoD, Department of Defense, already took a 15% stake in MP Materials in July, and those shares have more than doubled since then. So, my 2 cents on all this, we are clearly entering an era where there's government skin in the game, right? Scores of folks are going to grouse about that, and it's understandable. However, that's the world we live in. Would you rather have your government take an interest in preserving your security if it means investing in key companies, or would you rather call Beijing to see what's next or what's what? People forget that much of the world we take for granted today comes from projects with direct government involvement, including front and center, the internet itself. Other examples include GPS, semiconductors, aerospace, and commercial aviation, all of which are what they are today because they were either seeded with government spending or they worked hand in hand with Uncle Sam. Other governments around the world is very much the same thing in wherever you live and wherever it is you're watching this. It's not an antithetical relationship. It often goes hand in hand, and the most profitable investments are typically those that do work together, not that butt heads all the time. So, philosophically, I get it. I don't like it any more than you do, but realistically, that's a priority. Anyway, Keith's investing tip in this department: you can't argue with the odds when Uncle Sam comes to the table. Rare earths, lithium chips, defense suppliers are all prime candidates for this kind of relationship. And the buy list is pretty short if that makes sense. Quality companies will always bubble to the top or get a hand when they need it. Now, the One Bar Ahead family, of course, has already got a very focused list, and I'd love to welcome you on board if that's helpful. Today's bottom line is very closely related. It's one to keep front and center. Stick it on your screen, jot it in your journal, heck, even write it on your forehead if you have to. Whatever it takes to internalize this investing truth. Missing opportunity is always more expensive than trying to avoid risks you can't control. Let it sink in because it's something to live by when it comes to your money. As always, let's make it a great day. You got this, I promise. Thanks for watching. I will see you tomorrow. Appreciate it. Cheers.